In a volatile market like crypto, where Bitcoin's value can take ups and downs by thousands of dollars in just a day, risk management is essential for survival. In financial markets, wild swings are common and unexpected events can wipe out investments overnight. The old methods just don't cut it. This is why Christina Ray's book, Extreme Risk Management, feels so timely. It's not just about theories. It's a guide for making smart decisions in uncertain times. Today, we're taking a close look at the book, chapter by chapter, to see how you can move past outdated tools and think differently, which is what sets successful traders apart. Chapter 1, Plausibility versus Probability, Alternative Worldviews. In the first chapter, Christina Ray shakes up the usual ideas about risk analysis by comparing two different ways of thinking, plausibility and probability. She points out the shortcomings of traditional risk models that lean heavily on probability theory and historical data. While these models can handle everyday market activity pretty well, they often crash and burn when it comes to rare but impactful events, what we call black swans. Ray claims that models based on probability, which assume the future will look like the past, create false confidence. They presume that risks can be measured and that their patterns stay the same. But in reality, especially in fields like finance or politics, things are always changing, interconnected, and can be influenced by unexpected feedback, making the future hard to predict. To address this issue, Ray suggests using plausibility thinking as an additional approach. Instead of just asking, what's likely to happen, this method asks, what's possible even if it seems unlikely? This small shift allows analysts to think about a wider range of outcomes, including those that don't fit historical trends or current data. It's about being open-minded rather than just relying on math. She also points out that plausibility thinking is key when dealing with complex systems like global finance or national security, where tiny changes can lead to big results and the cause and effect can be hard to pin down. This leads to a crucial point. Not every important risk can be measured, and not all measurable risks matter. Ray also discusses how cognitive biases make decision-makers trust probability models too much, like the tendency to stick with familiar numbers or feeling overly confident. These biases can blind people to the subtle signals and insights that might signal something is about to go wrong. The chapter wraps up with a strong message for risk professionals. Adopt a mixed perspective. Use probability tools for analysis, but balance that with a storytelling approach that considers different scenarios. As she puts it, to manage extreme risk, we must be willing to imagine worlds that don't exist yet but could. The evolution of modern analytics. Christina Ray follows how risk analysis got to where it is today, starting from those old number-crunching models. She points out how things went from simple math to using stuff like machine learning to predict things. But she warns that better tools don't always mean better choices. She doesn't like when people just blindly trust these complicated black box models that don't make sense and ignore what's really going on. These models might be strong, but they often can't handle the unknown. Big changes, new dangers, or unexpected disruptions that you can't guess for what happened before. Ray says that even with all the progress, most analysis still depends on old info, so it repeats old mistakes. She wants to change things so analysis can adapt and understand how things really work, including why things happen, what's not certain, and how everything is connected. According to Ray, analysis should help people make decisions. Good analysis can help see options, point out problems, and come up with possible situations, but it needs to be understood with experience and common sense. She thinks the future of risk analysis isn't just about better programs, but about systems that understand the world and mix human thinking with cause and effect reasoning, risk management metrics, and models. This part gets into the tools used to handle risk, like value at risk VAR, stress testing, and looking at different scenarios. Ray explains how these models try to measure risk and guess what could happen, but she thinks they're used too much and don't work well when things get crazy. For example, VAR is often used as the only way to measure risk, even though it doesn't see how bad losses can be beyond a certain point. She says these models assume markets are normal, but that's wrong when markets crash or people act crazy and panic. Ray uses the 2008 crisis as an example of how these models didn't see how likely a big failure was. It wasn't that the tools were too hard to use. It's that people were too sure about their numbers and didn't understand why things happened. Ray wants a bigger view of risk, that includes the limits of numbers and includes things like rumors, behaviors, and world events. She talks about metrics that matter, focusing on being able to adapt, being sensitive to feedback, and spotting warnings early instead of just looking at stats. The main idea is that models are just tools, not facts. When things are risky, it's not enough to know the numbers. You need to know the story behind them. The future as forecast, assumptions implicit in stochastic risk measurement models. Here, Christina Ray asks some tough questions about guessing the future and the risky assumptions in stochastic models, those that use chance and stats to predict what will happen. She says that these models can help in simple situations, but they're bad at guessing complex systems like markets or world events, where things aren't just random, they're often a result of hidden causes. The chapter highlights key flawed assumptions in many forecasting models. Stationarity, assuming the statistical properties of systems remain constant over time. Independence, assuming that events are not interrelated. Linearity, assuming that outcomes move in proportion to causes. Ray proves these ideas wrong, showing how markets, economies, and security are shaped by complex interactions, emotions, and problems. She says that guessing in these situations is less about finding one right answer and more about imagining possible futures, especially bad ones. She says that good prediction needs different scenarios, creative thinking, and awareness of cause and effect. People who only use probability models don't see the biggest dangers, those that are outside what they predict. She ends with this: predictions shouldn't tell you what will happen. They should help you get ready for what could happen, especially if you've never seen it before. Chapter 5. An Alternative Path to Actionable Intelligence. Christina Ray suggests shaking things up when it comes to figuring out and sizing up risks. She thinks the usual ways spend too much time looking back and try and put numbers on everything. They often miss the bigger reasons why stuff happens. That means spotting early warning signs, figuring out what's not clear, and reacting to changes as they happen. She says most risk blunders don't happen because we don't have enough facts. It's because we can't make sense of them. Things are complicated, and what causes something might not be obvious right away. So, smart insights need to go beyond just looking at data. They need to tell stories that show the hidden connections. Ray suggests that risk experts and traders should get smart by using asterisk figuring out cause and effect, asterisk pretending different scenarios, asterisk using gut feelings, asterisk watching how people act. With this plan, the goal changes from being sure of things to being ready for anything. It helps people in charge deal with things that change fast and are uncertain. The main idea is that doing well when things are risky isn't about knowing everything. It's about understanding what you do know and acting fast. Chapter 6. Solutions, moving toward a connectivist approach. Ray talks about what's wrong with the old ways of figuring things out and suggests a connectivist way. This means focusing on networks, relationships, and being able to change quickly instead of following strict rules and trying to guess the future. She says knowledge isn't just stuff sitting in computers or people's heads. It's a system that keeps moving and changing because of people, tools, and tech being connected. This part talks about how a connected risk system helps groups and traders handle big risks better. Instead of just looking at old trends or using the same models, these systems asterisk taking info from all sorts of places, like money stuff, how people act, and what's happening around the world. Asterisk keep learning from new info. Asterisk let different people make choices based on what's happening right now. Ray also says it's important to work together instead of trying to control everything. Risk experts should team up with others to connect the dots, question things, and spot problems early. Ray thinks the risk systems of the future will be more like living things and machines. They'll be able to adjust, bounce back, and learn. Her main point is, to handle big risks, your system needs to be as complicated as the world around it. That means ditching simple plans and using networks that can change and adapt. Chapter 7. An Introduction to Causality, Theory, Models, and Inference. Ray gets into why things happen. This is super important for managing risk well. One of the biggest problems with guessing the future is mixing up what's related and what causes something. Lots of risk plans find things that happen together, but don't get why they happen. Ray talks about some ideas about why things happen, like thinking about what would happen if you change something. Ray also mentions using networks that show how likely things are to cause other things. This helps people go from just describing what's happening to explaining why. Then, they can pretend how changing one thing might affect others. It's not about finding the absolute truth, but about making up believable stories about why things happen. Then, you test them with facts and keep tweaking them as you learn more. Ray has stories from the real world of money and national security. They show how hidden reasons, like when people have the wrong goals, when rules are missed, or when countries don't get along, can build up and cause big problems suddenly. Ray says ignoring these deeper reasons and only looking at the surface is like trying to guess when a volcano will blow by only looking at the weather. Ray's message to traders and risk experts is clear. If you want to do well when things are unsure, stop reacting to every little thing and start figuring out why things are happening. Risk inference networks, estimating vulnerability, consequences, and likelihood. This chapter gets into risk inference networks, which is one of the coolest ideas in the whole book. Christina Ray says that old-school risk assessments usually stink because they look at data in silos and make guesses based on only one thing at a time. That doesn't work when stuff in the real world is all connected. Instead, a risk inference network is like a live map that shows how problems, triggers, and possible bad stuff are linked together. Ray says there are three main things to think about. Weak spots. Where's the system vulnerable? Likelihood. How likely is this bad thing to even happen? What could happen? How bad could the damage be? Ray talks about how risk inference networks can put all these things together and guess how risks could spread from one system to another. For example, if money dries up in one part of the market, it can mess up credit markets, trigger margin calls, and freak out the whole economy. Ray also points out that these networks can change as new information comes in. That way, you're always adjusting instead of just using some old risk score. These networks don't tell you exactly what will happen, but they show you possible ways that risk can play out. For traders, this means you have to think about more than just when to buy and sell. You need to understand how everything in the market is connected, from new rules to how people feel about the economy to technical problems. Making money this way is about being ready for different things that could happen, not just guessing what's next. Chapter 9. Securities Valuation, Risk Measurement, and Portfolio Management using Causal Models. In this chapter, Ray uses her cause and effect ideas to figure out what securities are worth and how to manage portfolios. Ray doesn't like regular models like CAPM or Value at Risk VAR because they assume things are normal, that stuff is always related the same way, and that everything is simple. But those assumptions fall apart when things get crazy, which is when you need those models the most. Instead, she likes causal portfolio modeling. This means finding the real reasons why assets do what they do, not just looking at patterns. This way of doing things uses cause and effect charts to show how the market works. Smart guessing to update your beliefs as things change. What if scenarios based on changes in the reasons why things happen, like new rules, world events, or tech changes? Ray also talked about ways to measure how well you're doing that look at more than just returns and how crazy things are. You also need to know how exposed you are to serious risks. A portfolio might seem like it's spread out, but it could be in trouble if all the assets are tied to the same thing, like what the Federal Reserve does. The main idea is that you make money by managing your portfolio with an understanding of how things are connected, not just by looking at old patterns. If traders and investors know why assets act the way they do, and how that could change when things get tough, they'll be much better off when the market gets wild. Chapter 10, Risk Fusion and Supermodels, a framework for enterprise risk management. In this chapter, Ray talks about putting different kinds of risk together, like money stuff, operations, strategy, cyber, and world events, into one smart model that Ray calls a supermodel. Usually, companies handle risks separately. Money risk is for the finance team, cyber risk is for IT, and so on. Ray says that this is a bad idea because everything is connected. For example, if there's a cyber attack, it can hurt the company's reputation, lead to fines, and make investors lose trust. All of that can mess up the company's money situation. The supermodel Ray talks about is based on figuring out how things are connected, using network models to guess how problems can spread, constantly getting feedback to stay flexible. Ray compares this to how national security agencies put together information from different places to figure out what's going on. In the same way, a trader or a risk manager can use this approach to see risks coming before they cause problems. This chapter is super useful for fund managers, big investors, and corporate risk teams, but it's also good for individual traders who are serious about what they do. It shows that making money isn't just about getting lucky. It's about being able to bounce back, seeing things coming, and changing your plans when new information changes the situation. Chapter 11. Inferring causality from historical market behavior. This chapter tackles a big question in finance. Can we really know what causes what by looking at old market data? Christina Ray says that most models focus on what things happen together, but it's way more useful to figure out what actually makes things happen. It's about finding the real reasons behind market moves, not just spotting patterns. Ray walks you through some fancier ways to analyze market history, like Granger causality and Bayesian networks. But most importantly, she warns us that the past isn't going to repeat itself exactly. Traders need to build models that can adapt to changes in what causes things. Stuff like new rules, shifts in how investors think, or world events. She shares examples of how markets can act weird when the reasons behind the moves change. The 2008 crash is a great example. Those mortgage security models failed because they assumed housing prices would always move together in the same way. The big takeaway here is, don't just blindly trust old data. Build systems that try to understand why things happen. Watch out for big shifts in the market, and be ready to change your mind about what causes what as the world changes. It's all about being smart and adaptable in the market. Chapter 12. Sense-making for warnings. Reverse engineering market intelligence. In this chapter, Ray switches gears and talks about how to think like an intelligence analyst. She explores how to spot early warning signs in the market before they become big news. She takes the idea of sense-making from the military and applies it to finance. Ray says sense-making is a constant process of collecting info, guessing what it means, testing those guesses, and tweaking your models. It's not about getting the right answer right away. It's about being flexible and constantly learning. She gives a plan for building a warning system for traders and analysts, including watching for things that don't fit the usual patterns, seeing when things stop moving together the way they used to, paying attention to what's being said outside the market, politics, etc., thinking about what-if scenarios. Ray stresses that the real insights come not from just guessing the future, but from asking what would have to be true for this to make sense, and staying sharp to pick up on clues that things are changing. This chapter is super valuable for traders. It encourages you to think like a detective, constantly learning, adapting, and rethinking how you see risk. Sense-making isn't just a tool. It's how you survive in uncertain markets. Chapter 13. The United States as Enterprise, Implications for National Policy and Security. In the last chapter, Ray steps back from markets and companies to look at the United States as something that needs to manage risk. This chapter isn't so much about trading, but about big-picture national risks. Still, it's got clear implications for big investors and global strategists. Ray talks about how risk management ideas, like mapping relationships, using models, and figuring out cause and effect, can be used for national policy, particularly now that economic, cyber, environmental, and world risks are all tangled together. She suggests that politicians should use an intelligence model, like the ones that financial firms are starting to use. The goal is to not just react to problems, but to see them coming before they become huge. Ray argues for using data to make decisions, looking at risks across different areas, sharing info between the government and private companies, using intelligence models in defense and economic planning. For big investors, global traders, or anyone who invests based on world events, this chapter has a serious message. You're not trading in a bubble. You're trading in systems connected to national-level risks. Understanding that can give you an advantage and help you dodge huge losses. Extreme risk management is a paradigm shift in how we think about uncertainty, forecasting, intelligence, and survival in complex systems. Christina Ray's work challenges every serious trader, investor, and policymaker to move beyond reactive models and into a mindset of proactive, causal, and adaptive intelligence.